Welcome to The Explainer. Today, we're going to unravel one of the most fascinating mysteries in real estate finance, how real estate investment trusts, or REITs, actually compound your wealth over time. If you're the kind of focused learner who wants to get way past those surface-level dividend yields and really understand the underlying machinery of property investment, you are in the exact right place. We're going to open the hood on how these massive property portfolios generate cash and figure out how we can spot a true wealth builder versus a value destroyer. Let's get right into it.
Picture this. You've got two REITs. They start at year zero with identical portfolios in the exact same starting dividend yield. Now fast forward a decade. 10 years later, that REIT on the left, it's completely stagnant. It still owns the exact same 3 buildings and pays you exactly what it did in year 1. But the REIT on the right, it's paying you double. It's got more buildings, way higher rents, and vastly greater distributions. So you have to ask, what changed? Well, the difference isn't market luck. The difference is whether the management team actually master the 2 fundamental growth engines of real estate. So let's explore that first one.
Engine number 1 is internal growth. This is the quiet, cheap, and honestly beautiful way to squeeze more income from the buildings a REIT already owns. And the best part? It requires absolutely zero new capital from the markets. This engine fires on 3 specific pistons. First up, increasing same-store net operating income. Second, rent bumps. These are those contractual escalations baked right into the leases, meaning automatic raises, no negotiation needed. And third, cost efficiencies. We're talking smarter energy use, leaner operations, where every single dollar saved flows straight to the bottom line, or in your case, straight into your distributions.
Now I want to pause on that first piston for a second because it's absolutely crucial. Same-store NOI. This is the net operating income generated only from properties the REIT has owned for at least 1 full year. It deliberately excludes new acquisitions because new buildings usually have high sales growth that can kind of mask underlying problems in the rest of the business. By looking only at the same stores, we get the absolute purest health signal of the existing portfolio. It tells us exactly how well the current assets are performing in the real world before management goes out and buys anything new.
All right, shifting gears to Engine 2. Engine 2 is external growth. This is when the REIT reaches outside its fence to acquire or develop brand new assets. But here's the secret we've got to keep in mind. Just acquiring a new building doesn't automatically mean we get wealthier. The true magic of external growth lives entirely in one single metric, and that's the development spread. This spread is simply the property yield minus the REIT's cost of capital. That is, without a doubt, arguably the most important math equation in all of real estate.
Let's look at a textbook example of how this works when it's done right. Imagine a REIT builds or acquires a new property at a 7% yield. But to actually fund it, using a mix of equity and debt, their capital costs them 4%. That gap right there, that 3% spread, is pure, recurring shareholder value. It is literally minted the very second the deal closes. The wider that spread is, the more each and every acquisition enriches you as a unit holder. When a REIT hits this consistently, external growth is just firing on all cylinders, and it's incredibly exciting for your portfolio.
But what happens when this goes wrong? Imagine a REIT goes out and buys a flashy new property at a 4.5% yield, but their cost of capital to fund that exact deal is 5%. The spread flips negative. It's bleeding red. Every single deal they do with this math actually destroys value, even while all those corporate press releases and headlines are celebrating the massive growth in their portfolio size. This is what we call the dilution trap. It's growth that is literally robbing you.
To ground these corporate finance concepts in reality, let's just use a simple coffee team or coffee shop analogy. Internal growth, Engine 1, is the coffee team owner raising the price of a cup of coffee from $1.40 to $1.50 while fixing a leaky gas line to save on utility bills. It's the exact same stall, just much more profitable. External growth, Engine 2, is that same owner opening a second stall across town. But they should only do it if that new stall returns 7% on the money they had to borrow at 4%. You raise prices in-store, and you only expand externally when that spread is fat. And here's where the math gets really fun. When you combine these engines, say 2% annual rent escalations plus 1 well-spread acquisition a year, a REIT can compound distributions 5 to 6% annually. That is the exact formula that doubles your income in about 12 years.
So how do we evaluate this in the wild? Let's compare 2 different scenarios. REIT A develops a new building at a 6.5% yield, and their capital costs them 4%. REIT B develops a building at a much flashier, higher 8% yield, but their cost of capital is 7.5%. As an investor, which management team is actually creating more value for you?
The answer?
It's REIT A, and honestly, it's not even close. REIT A is generating a massive 2.5% spread on their capital. REIT B, despite that headline-grabbing 8% yield on the property, is only scraping out a tiny 0.5% spread. This proves a fundamental rule of REIT investing for sure. Yield means absolutely nothing if you don't know the spread behind it. The spread decides your wealth, not the property yield alone. Okay, so we've got the two engines down. Now we need to talk about the ultimate insider secret to evaluating the mechanics of a REIT, checking how the management team actually gets paid, because this is where conflicts of interest just love to hide. There are generally two ways these fees are structured. The first is based on a percentage of assets under management, or AUM. This heavily incentivizes empire building. The manager gets paid more simply by making the trust bigger, even if it dilutes your earnings. The alternative is a fee based on a percentage of net property income, or NPI. This structure properly aligns the manager with you. They only make more money if the properties actually generate more real profit. Think about it like hiring a property agent. If you pay an agent just per viewing arranged, well, you're going to get 50 completely useless viewings. You're paying for activity. But if you pay that agent a cut of the rent they actually secure for you, they're going to hunt for high-quality paying tenants. You are paying for outcomes. An income-linked manager, one paid on net property income, is forced to hunt for real value, polishing those existing buildings and ensuring positive spreads on new ones, instead of just empire building with your invested capital.
Let's play this out in practice. Imagine Manager A's fee is 0.5% of assets under management. Manager B's fee is 10% of net property income. Now imagine the trust aggressively doubles its asset base by buying up literally everything in sight. But because they bought at negative spreads, the actual income per unit holder falls. In this scenario, who got richer?
Yep, Manager A gets richer. They doubled the size of the asset base, so their fee doubled, while you, the investor, suffered dilution and lower income. If Manager B had been in charge, their pay would have fallen right alongside yours. This highlights exactly why fee alignment protects your portfolio from serial value destroyers. Excessive base fees that leak out of the trust to an external manager are one of the biggest red flags to watch out for. Alignment isn't just a nicety, it's the whole game.
All right, so we know how a REIT grows its income, and we know how to make sure the manager isn't stealing that growth. But how do we actually measure this profit accurately? If you look at standard corporate finance, you just use net income. But for real estate, net income is deeply flawed. Why? Because generally accepted accounting principles require properties to be depreciated over time as an expense. But in the real world, well-maintained buildings often retain or even increase in value. So deducting massive depreciation makes a totally healthy REIT look artificially unprofitable. We need a much better metric. Enter FFO, or Funds from Operations. It's a measure of the cash generated by a real estate investment trust from its regular ongoing business activities. It completely strips away that accounting fiction of property depreciation to reveal the actual, pure cash coming in the door from the REIT's operations. This is the metric that truly tells us if those internal and external growth engines are genuinely working.
So let's quickly walk through how our FFO is actually calculated so you're never fooled by a balance sheet again. It's pretty straightforward. You start with standard net income at the bottom of the income statement. Then you add back depreciation and amortization, because as we just discovered, that isn't real cash leaving the door. Next, you add back any losses on the sale of property. And finally, you subtract any gains from property sales and subtract interest income. We subtract property sales because selling a building is a one-time event, not a recurring operational cash flow, right? By doing this, FFO isolates the true, repeatable cash the properties generate.
So let's bring this all together. You came into this explainer knowing that REITs collect rent, but now we actually understand the mechanics of how they grow that rent. We know to look for Engine 1, internal growth through same-store NOI. We know to check Engine 2, external growth via positive development spreads, and we know the ultimate insider check, ensuring the manager is paid on income, not asset size, while measuring it all through funds from operations. So here's my final challenge to you. Look at the very last acquisition announced by a REIT in your portfolio. Don't just look at the headline yield. Calculate their cost of capital, what is their spread, and are their fees actually aligned with your success? Take these tools and go evaluate your portfolio right now.